Right. Good morning or good afternoon, depending on where you're joining us from. My name is Len Jordaan. I'm with S&P Dow Jones Global Indices, and I'll be your host on the panel today that's discussing the performance of African stock markets for the year 2020. And obviously, it's been quite a tumultuous year, and I'm sure there'll be a lot of interesting insight that comes from our panelists. So down the panel, I'll start with the person that's furthest away from me here in South Africa, is Fred Steiner. Fred's with BCCM Advisors. Fred, I know that you guys have long-only funds as well as hedge funds. Do you want to give us a little bit of insight into your role with Africa?
Sure. Work for BCCM Advisors, run the Blue Clay Pan-Africa Fund. We have offices here in Minneapolis as well as in Nairobi, Kenya. And we focus primarily on consumer and technology-enabled businesses on the continent. So
fantastic.
Happy to be here. Thank you for hosting.
And it's a bit colder where you are than when we are in South Africa, so try and stay warm. Next, I suppose
quite a bit.
Next, it's Andy Gboka. Andy is with Bellevue Asset Management, and he's in Switzerland, which I imagine is quite cold too, Andy.
Yes, you imagine well. So yes, I'm working for Bellevue Asset Management, running the Africa and Opportunities Fund. The fund was launched back in 2009 by Malek Boudia, my colleague, and I joined Malek back in 2015 to run the fund with him. And prior to that, I was a sell-side analyst at Exec in London. So I would say I have more or less 10 years of experience covering Africa from the sell side, but also the buy side now. And I thank you for hosting us and organizing this call. Thank you.
Fantastic, thank you. I see we've lost our third panelist who's sitting in London, Francis Harcus. I hope he'll be able to join us a little bit later. But with me on the African continent is Gerald Gondo. Gerald is with RisCura, which is a consulting company that I'm sure most of you are familiar with. Welcome, Gerald.
Sure. Thanks, Len. Again, it is a pleasure for me to be on this panel. RisCura, we assist asset owners, institutional investors in terms of their investment governance framework, so helping them make better decisions in terms of not only how they're conducting their investments, but how they're thinking through making their investments, not only on the African continent, but globally. And specifically for me, I'm involved in the development of RisCura businesses on the African continent and assisting on-continent African pension funds in terms of their implementation of their investment governance.
Fantastic. So everyone here today has skin in the game. I live here, so I've got quite a bit of skin in the game as well. But I think, looking back at the performance of the continent as a whole, S&P obviously calculates indices for each of the countries, but we calculate an index for the total continent. And that kind of broke even for the year of 2020, which was probably a surprise to me in terms of I expected the performance to be worse. When I drilled down into the performance of the constituent indices of the countries that make up that index, it became obvious that there was quite a lot of diversion between the returns of the various markets within Africa. And have a look at Nigeria was up over 20% for the year. Tanzania, Malawi, and the Ivory Coast were all up 20%. But then on the other side of the scale, we had Mauritius, Namibia, and Zambia that all had over 20% losses. So I think that to me, firstly, was an illustration that Africa is not some big homogeneous landmass where all the markets are influenced equally by what's going on in the world and the different economic drivers, but that each country has its own nuances that it needs to understand. It has its own currencies, it has its own stock markets, it has its own cultures. Fred, for you guys, I mean, once you've established a knowledge of the African continent, is that something that really entrenches you quite well? Is it intimidating for investors to come into the African market as equity investors?
Yeah, so I think the biggest hurdle that we face when we speak to investors or prospective investors is just kind of getting over these more or less legacy issues of like just perception of corruption, perception of that there isn't urbanized city centers outside of South Africa or Cairo. So that's that can be kind of an impediment, I think, for just some US-based investors to get their head over. I think in terms of just broad-based barrier to entry, look, it's going to be difficult for some global institutional investors to raise a fund because it's difficult to scale funds on the continent. So it's you couldn't just flip a switch and launch $1 billion Pan-Africa fund. It would be very difficult to move, to navigate. So size certainly matters. You need access to a global custodian, whether that's kind of Citi, Standard Bank, who's on the call, JP Morgan. You need the likes where they have sub-custodial relationships in each of the countries where you may want to invest in equity markets. So I think there are barriers to entry, and it allows kind of smaller, nimbler players to participate and hopefully thrive. And then, yeah, I'd leave it at that.
Okay, and I suppose it's come a long way in the last 10 or 15 years, because Africa was almost divided into English-speaking and French-speaking for a very long time and was serviced by very niche players in both of those markets, whereas now they tend to be playing across the continent. So I would probably, from what you're saying, say that there are quite big barriers to entry, but that they're slowly going away. Is that an accurate summation?
Yeah, I wholeheartedly agree with that. If we speak to investors in Nairobi, they're talking about wanting to gain exposure to Pan-Africa as opposed to just Kenya. You see that in other countries as well. So that's absolutely the case. It's just kind of a matter of time. We think just as the internet, we'll touch on this later, but just the internet is democratizing all sorts of verticals. And one of these is going to be financial services and access, broad-based access to the continent. So, but today, for instance, I couldn't open a brokerage account here in the United States and have access to Kenya, which is, to me, a shame. I need one of these large global custodians to be able to invest on the continent. So, but as you mentioned, we've come a long way in 10 years, and I suspect in another 10 years, almost all those barriers will be broken down. It's just about size. Then it comes down to size and being able to scale.
Yeah. Andy, is it your experience as well? I mean, I see that there's 7 big stock exchanges in Africa now that are talking about a cooperative arrangement whereby they can cross-list. I would imagine that cross-listing and sharing of technology will benefit the countries that have smaller exchanges or using older technology.
Yes, definitely. And one other point that I wanted to add, for example, is, I mean, I think Fred touched a bit on it earlier. It's the liquidity. When we look at markets like Tanzania or Rwanda or even like Zambia, for example, and to some extent Ghana, the liquidity is not that great, and accessing those markets as foreign investors is a bit complicated, because obviously, you know, we need to be able to enter those markets easily, buying stocks, and also exit easily as well. And when you have those liquidity issues, it doesn't make our life easy. And yeah, I think having those common exchanges could help, bringing all the infrastructure together, and having regional investors, you know, being able to trade on these common exchanges could also help improve the liquidity. So that's one of the positive sides, I would say, regarding these common exchanges. However, we are still a long way from there, and the only exchange, I would say, where you see different countries represented is the BRVM, the West African Stock Exchange, la Bourse Régionale des Valeurs Mobilières, where you have Ivory Coast, Mali, and other countries from the West African Monetary Union, the CFA franc, that are represented. But if you look at East Africa, for example, you still have Kenya, Tanzania, and Rwanda that are still not trading on the common platform. Another solution as well could be to have dual listing as well. You know, you have it for a few names listed in East Africa, either in Rwanda and also in Kenya. So this could be another solution, but things take time. and hopefully we'll get there soon.
Yeah, and I know there's been some cross listings of ETFs from the Johannesburg Stock Exchange up onto various exchanges in Africa, Kenya and Nigeria being two of them. And I suppose that resolving all these kind of technical issues will benefit the equities market generally in the long term. And hopefully we'll have some African products listing down in the JSE sometime soon as well. Just looking at the business case or the investment case for Africa, I suppose the comparisons with countries like China and India are inevitable, just because all of those territories tend to have very large populations. Over a billion in each of those areas. Is the investment case the same for Africa as it was for China 25 years ago, when China started becoming an interesting topic? Fred, do you want to touch on that first?
Yeah, sure. So drawing parallels from Africa to China, so, I mean, some of the obvious differences is, look, 55 countries versus one, all sorts of different cultural differences on the continent. Africa being largely kind of carved up, if you will, geographically, as opposed to by cultures. And so those are kind of like these stark differences versus China. But to your point, look, if you look at demographics and urbanization, and then Renaissance Capital did this piece on the role of literacy rates and how they connect to industrialization. And we thought that was pretty fascinating. And so just starting with demographics and urbanization, if you look at China in 1990, the median age was 25, and it was about 26% lived in urban areas. If you go to Africa today, there's about 100 million more Africans today than there were Chinese in 1990. Today's African median age is 19. 60% of the population is under the age of 25. And by 2025, 190 million Africans are expected to relocate to urban centers. This basically, and by 2035-ish, according to McKinsey, you have Africa's labor force being larger than that of India and China. And so you can basically call it that 2/3 of Africa's metropolises have yet to be built. And then you have Quartz saying that 86, Quartz, the online, I suppose, publisher, it says 86% or 86 of the top 100 cities in the world that are growth rates are in Africa. So thus you have Africa is similarly young, populous, and urbanizing, but you also have a higher growth rate in terms of population growth rate. So that's on the demographic side. So you can draw parallels there, which is great. But the interesting side that we think is, again, this Renaissance Capital, the role of literacy rates in industrialization. And so when literacy rates hit 70%, you become, as a nation, a candidate for industrialization. And then by 80%, you're well on your way. And so similarly to China back in 1990, actually China in the 1980s, it was in the mid 60% literacy rates. And by early 1990s, you were just shy of 80%. And that was the time when China really began to lay the foundation for its industrialization ramp. Today, in 2000 in Africa, you had just 4 countries that were candidates for industrialization. By 2015, it was 15. Now we suspect in the mid-20s. And so you've seen these literacy rates ramp from sub 70% to in the 80s in many countries and above. And so those countries should, according to this kind of framework, should do well to industrialize. So that's these are like very long, large secular plays, right? But it certainly is bullish, if you will, if you're willing to take a long-term horizon and kind of ride out the volatility. So.
I can't hear you, Len. I guess I can go ahead.
Go for it.
Just to follow up on the industrialization that Fred just mentioned, he mentioned literacy, and doing the parallel versus China, there is another point that is quite important as well, is the infrastructure that you have in some of the countries in Africa. And when you look at China, let's say in the mid-90s, for example, they were already coming out of a big phase of investment, in roads, power, and different type of infrastructure that would help them to accelerate and reach a certain level of industrialization. And looking at Africa today, I would say that there is a clear lack of investment in infrastructure that makes it more complicated for, I would say, most of the continent to industrialize fast. Obviously, there are a few examples where the infrastructure is already there. I'm thinking about Morocco, for example, which is very well ahead. You have roads, power, adequate power, and also Egypt as well, and to a certain extent Kenya. Obviously, South Africa, which is the most industrialized country in Africa. So you have a few examples where I would say infrastructure are in place to help drive this industrialization. But when you look at, I would say, the majority, unfortunately, of the countries, and one big example is Nigeria, where power costs a lot of money, transportation is a high cost as well. So when you are operating in those countries where you have a difficult access and costly access to transportation and power, it doesn't help you, in this industrialization phase. So this is something as well to keep an eye on when we talk about Africa growing, the industrialization of Africa. And just to mention it as well, we wrote a piece on the investment in infrastructure in Africa last year that is worth reading, and talking about, yes, the power of infrastructure to help Africa achieve its growth potential. I think this is something that could be quite interesting to read. I think you are on mute, Len.
Sorry. Thanks for that. Maybe you can put a link to that article in the chat section, if you could. And just for everyone who's watching, if you do have questions, would you mind just posting them in the chat section, and we can get to them a little bit later. I think we have Francis back. Welcome, Francis.
Apologies, I've been having a serious technology fail. A little late.
We've just been talking about infrastructure and the development of infrastructure. Is the UK having a problem with bandwidth?
Definitely having a number of problems. It certainly didn't like me trying to connect to my AirPods.
So Gerald, I know you're going to try and avoid this question, but it sounds like there's a good case for global investors to be investing in Africa. And yet when we look at the asset allocation of African pension funds, they all seem to be underweight African equities. What are the reasons for that? Are they not convinced of the African equity story, or there's some legacy issues there from the way pension funds were set up previously with defined benefit kind of structures?
Yeah, it's I suppose it's a developing narrative in that you're starting to see many more African pension funds, many more social security funds really migrating away from what really was their default asset class, which was buying government bonds, domestic government bonds, and channeling more of the asset allocation not only to public equities, but also developing infrastructure, developing private equity as an asset class, developing real estate and the like. And I suppose it's a function of the fact that many African institutional investors are conscious to the fact that because they are large constituent savings bases in their countries, they do need to play a role in terms of deepening and developing their capital markets, hence diversifying their asset allocation. But more importantly, I think the realization that the drive of returns, particularly for what is a very youthful cohort of people in many African nations that are really only starting to save now, has to be channeled into more than just government bonds. But having said that, if you look at local currency bond investors in Africa, the yield play is still very lucrative. So, whilst we may not have seen massive inflows, for instance, into public equities in the last couple of years, you've also seen a very strong emergence and growth of both African Eurobonds as an asset class, as well as global institutional investors looking to local currency as a yield pickup, given the very low yields that they face domestically. What we find encouraging about that is that you're now starting to see deepening and breadthening of African capital markets beyond just public equities, but across all asset classes. But we do take the point, and I'm sure the panelists agree that the entry point into public equities is still quite difficult, particularly if you're looking at the smaller countries. But things like the African Exchange Linkages program are starting to make that a lot easier. But pension funds will remain the bedrock of the development of African capital markets.
Fantastic. So I think one of the sad things for me is when you look at the African economy, or what the basis of most African countries is really commodities, and yet we don't have a terribly high weighting of commodity stocks on African exchanges because they tend to list in countries like Canada or Australia or South Africa. Then the other thing is that I suppose the infrastructure investments have provided relatively lucrative returns for investors, and agriculture has also taken quite a bit of the investments. Has that resulted in less interest for equities as an asset class? So sorry, let me say that more succinctly. Have the returns in other asset classes prevented people from going into equities just because equities, you can get a good return, but it comes at a little bit of extra risk? Maybe I'll pass that to you, Francis, since you've just joined us.
Thanks. Look, I'll first admit I'm kind of no expert on infrastructure and the returns that have been generated there. But I think what I would say, and probably echoing something that Fred said earlier, is that the primary issue is really just one of depth, right? And the reality is, a lot of the regions exchanges are still, very shallow in terms of the number of opportunities that are available to people. And I think that will change markedly over the next few years. In particular, there was a lot of private equity capital that was raised 6 to 7 years ago, which is going to be thinking about kind of exit strategies. And I think we'll see a number of listings, whether those listings happen in market or on international exchanges. You've seen big names like Jumia, trading very actively in the USA. Remains to be seen. I think it will depend to a large extent on the size of the individual companies. But I think, in terms of kind of, I guess, sector allocation, I mean, clearly, yes, Africa remains in many countries exposed to the development of commodity cycles. That obviously has in itself a massive impact on currencies, and it's been the defining theme over the last decade. It's been very, very difficult for anyone to get a US dollar return on account of the currency depreciation, which in most instances has exceeded 60% against the dollar. So I think from my perspective, the long-term opportunity remains as compelling as ever, but I think people would do very well to remember that it's going to be a very long and kind of bumpy road, and these kind of commodity super cycles will kind of continue to come and continue to place pressure on currencies. I think we've experienced an uncharacteristically large or long bear market insofar as kind of FX is concerned, but it will continue to happen, and people just need to kind of factor that into their overall expectations and of course the sectors that they are investing in.
Yeah, thanks for that answer. I mean, I think that answers one of the questions that we had in our chat group as well about exits into IPOs. Is that something that you think will happen regularly? Are African exchanges a viable listing opportunity or listing destination for small but growing companies in Africa, or do you think they'll look to externalize themselves on the foreign exchanges?
I mean, I think to the point that Andy made earlier, there's massive differences between individual exchanges, right? I mean, you know, the Nigerian exchange is very different from its neighboring exchange in Ghana in terms of the quantity of listings and aggregate market capitalization. So, you know, I think we'll see a mix of approaches depending, as I say, on business size, on kind of what the equity story is. You know, you'll see some businesses dual list. We've already seen that, and so I think there'll be a range of outcomes. I think, you know, for the long term, I would certainly like to see kind of more listings in market and to see the development of exchanges. I think that would be very healthy for the overall kind of investment pool. And again, to the point you were talking earlier about pension funds, you know, the development of that kind of local institutional capital base is so critical to having a kind of healthy and vibrant set of local exchanges as well.
Yeah, absolutely. Sorry, Fred, you had your hand up a little bit earlier, and then we'll get to Gerald.
Yeah, just one thing I was going to add is I think startup capital was almost non-existent even just a few years, like call it 5-7 years ago on the continent. I think India had something like 28 times the amount of startup capital that Africa did, and that gap has closed to 6 times. So you're seeing more of sort of venture money finding its way as capital markets become again more democratized. Just like capital will eventually find that brilliant programmer in Lagos or in Nairobi or Cairo. It just takes time. I think with when we speak to, because we do some late stage investing in the private side as well, when we speak to founders, they're often talking about listing on the LSE or they're listing on the NYSE. So I think the local exchanges are going to have, for some of these larger kind of backed, maybe Silicon Valley backed as well, companies, these local exchanges might have trouble kind of maintaining that, which is really too bad. We'd love to see at least dual listings, just so that locals can participate in that wealth creation. So yeah, we'll see where it goes, but the bright side is that you're seeing a lot more venture funds come in and participate in startups.
Yeah, and I think that's probably exacerbated by the fact that these large exchanges are under a little bit of pressure from a business model perspective and are actually targeting a lot of the big companies on the smaller exchanges. So that always makes it tough for the guys in Africa. Gerald, you had your hand up earlier.
Muted.
There we go.
Yeah. So speaking specifically to really IPOs on the continent, what we found, and we've just finalized some research on it, I've put the link in the chat room, is that disappointingly, the study period was from 2014 to 2019, you actually had more delistings than listings across the African continent. But, that's just the surface level information. When we dug a bit deeper and actually looked at the nuances between East Africa and West Africa versus, common markets like the BRVM versus Sub-Saharan Africa, you started to really discern that the development of stock exchanges as institutions themselves actually also has a bearing as to what IPO activity is going to take place. So for some African countries, the development of a stock exchange, and Zambia is a good example, was really a function of, a government undertaking a privatization drive under the auspices of, the IMF or the World Bank. And one of the things they had to do was to create a stock exchange. But the downside of that is that most of the companies that initially listed on the stock exchange were really state-owned enterprises or public enterprises that were recommended to be privatized. And they weren't necessarily the best governed or most functional entities in the first place. So, you know, you kind of ended up with lemons on the stock exchange, and that's not attractive to the development of the capital markets. But similarly so in places like East Africa, what was very apparent was the fact that listing is just one of many options that a small to medium-sized enterprise has in East Africa. And in East Africa, a big constituent funder is family and friends. And, you know, they have the ability to keep funding the business until it's very scalable, and then comes in private equity or trade buyers or the like. So, you know, you're seeing across the African continent an awareness amongst stock exchange operators that the provision of capital to the development of SMEs, they actually need to compete with other sources of capital, of which private equity is one. And they actually need to configure the stock exchange to make it attractive to SMEs to look at the stock exchange as a source of raising capital compared to other capital providers. And to that end, I think they're alert to it. You're starting to see many main stock exchanges developing junior or mid-sized stock exchanges that have different criteria to allow for small, medium-sized enterprises to be made public. And then I think lastly, again, speaking to the regulatory environment and speaking specifically to pension funds, it's also changing legislation or changing regulation to allow them to start looking at small and medium-sized enterprises. Things like, you know, 3 years, you know, audited financials. If you are expecting an SME to list, just may not be possible, right? And if you're not changing the mandates for many of the managers who are managing pension fund money to be alert to that, it's unlikely you're going to start to seeing the flow of capital to supporting those emerging businesses. So hopefully in the near future, you'll start to see more IPOs, maybe not on the main bourses, but one has to now start to look at the mid-size and junior bourses that are being created on the continent as well.
Yeah, absolutely. And I suppose you've only got about a 5 or 10 year lead time until some of those companies might migrate to main boards. I think that's something that the JSE did quite successfully. Is they've got a junior mining board, and they also started a smaller exchange where you didn't have to have any profit history at all. So these are novel ways, I think, of addressing that problem. So I suppose in the absence of commodities in Africa, the big sectors are banks or financials, consumer stocks, property. Fred, any others that I've left off there?
Well, telcos.
I was going to say telcos, but that's the bulk of the market cap. Yeah.
Great, but I think the first few that I mentioned, I think telcos were relatively resistant. But the first few that I mentioned were the ones that got really pounded in the COVID with the COVID epidemic. Now we've seen a lot of African countries complaining about the fact that they're kind of at the back of the queue when it comes to vaccines. And I would imagine that the lack of good infrastructure also affects African countries' ability to roll out large-scale vaccination programs. Andy, what's your impression of how Africa has handled COVID? I saw some quite scary statistics about the impact that it's had on local economies.
Okay, where can I start from? Okay, starting from the way I would say that they handled it at the beginning of the crisis pretty well. I mean, when you saw countries like Morocco, for example, they were the first to close the border. And they didn't wait like countries that we saw in Europe, France or Italy, before implementing some measures. So in the first reaction, I would say that they were quite reactive and quite decisive in the different measures they put in place. And then obviously you had the lockdowns across the different countries in Africa, whether you talk about South Africa, Kenya, Nigeria, and Morocco. So you had hard lockdowns as well. So they kind of followed, or actually they were a bit ahead in terms of measures compared to European countries. I'm not talking about Asian countries that were a bit more reactive. Now, having said that, and to come back to your first point on the vaccine, what we're talking now, the securing access to the vaccine, I would say that Africa seems left behind. First of all, I guess because the relationships of African countries with the main pharmaceutical companies developing those vaccines are not that strong. If you look at Pfizer, BioNTech, for example, US and Germany. If you talk about AstraZeneca, and Oxford University, this is UK, and I think Northern European countries, I forgot the name, I apologize for this. So obviously it's less easy for those countries to secure vaccine access, but also money-wise as well, to afford for it. To give you a few figures, talking about the African Union, they managed to secure between 250 and 350 million doses via different supply contracts with different sources, different pharmaceutical companies. But at the broad scale of the continent, this is nothing. We're talking about a continent which is more than 1.2, 1.3 billion people. And if you compare that to the US, that has already secured 600 million doses to be supplied by June or July this year, you can clearly see that the access, securing vaccine access is a bit more difficult for African countries. Having said that, you have different initiatives in Morocco and Egypt where you see that they are trying, to secure vaccines from Sinopharm, AstraZeneca, and to start their vaccination campaigns. But yes, generally, I will say that talking about vaccinations, Africa is quite late, and yeah, we hope that things will go much faster. But once again, if you look at France as well or Italy, they also have their own problems, logistical problems, and the resistance of the population as well. So it's not easy in Europe, and obviously in Africa it's not easy either. But they are making everything possible, to secure those vaccine access, and hopefully in the second half of this year they will be able to vaccinate a bit faster the population. And I don't know if you wanted to touch about market performance as well, or maybe at a later point.
No, we can jump into that now while you're on a roll.
Okay, so on this as well, I would say at the beginning of the COVID crisis, so let's say March, when it was pretty clear that it was an issue and it would affect all stock exchanges globally. Us, as I would say, portfolio managers, we were expecting most African stock exchanges to be affected negatively. But having said that, we thought that the drop in African stock markets will be much lower compared to the drop in developed markets and EM markets, because generally African stock exchanges enter the crisis with much lower valuation multiples. So we thought that this lower valuation will act as a cushion to the pressure on stock exchanges. And obviously when we saw the monetary easing, fiscal easing globally, but also at a local scale, talking about South Africa, Egypt, and the other markets, we thought, well, those markets will rebound quite fast and quite strong as well. But I would say almost a year post the crisis, the reality is that during the correction, we noticed that stock exchanges generally in Africa perform much worse, or at least in line with developed markets and EM markets. And in the rebound, they tended to lag a bit the rebound that we saw in developed markets and EM markets, especially comparing to Asian markets. And there are a few reasons for this. Just to finish on that, the main reason obviously is the currencies, the local currencies. If you look at the most FX across Africa, they depreciated a lot versus the US dollar. So your performance in US dollar is affected. Second, obviously we had big outflows from foreign investors out of African markets and going back to developed markets. And when the flows came back, they haven't come back yet to listed equities in Africa. We've seen a comeback in the fixed income space. Some of the countries managed to recover almost all of the fixed income portfolio flows that they lost during the crisis. But in the equities, it takes time. Another reason for that as well is the appetite from local investors that tend to stay in the fixed income space as well. And they were not really supportive, I would say, coming and buying some equities even during the worst period. And one last point, and I think Fred may complement that point, is on the tech side as well. In Africa, you don't have Alibaba, you don't have all the tech names that support the developed markets and EM markets. You have a few names, obviously. You have Naspers in South Africa. More recently, Jumia and also Safaricom that could be seen as a tech name in Africa. But, you don't have that many opportunities, in these tech names in Africa. And so obviously, those markets lacked this kind of market access or opportunities that we saw helped a lot the EM and developed markets. So that's what I could say about the performance during the COVID and now at the moment, actually.
What about the rest of the year? We've seen commodities obviously start the year quite strongly. A lot of them produced or mined in in Africa. Could that help stabilize the currencies and stabilize the economies of those countries, or is the damage that bad that there's that the commodity prices won't support those equity prices? I'll ask you to comment on that as well, Francis.
Sorry. So I'd say on the currency side, look, we are roughly speaking kind of 7 years into a kind of US dollar bull market, right? Potentially a little bit longer. That is, as I said earlier, kind of uncharacteristically long. If you look back over the last almost 80 years. I think what I would say is that there were a couple of factors that probably delayed the dollar sort of topping out versus in particular EM currencies. I mean, namely we had a trade war ongoing with China, and then a huge amount of uncertainty from the pandemic, which is obviously supportive for the dollar and gold and other assets. So I think, holistically, high commodity prices are by and large good for most African economies. They remain very important to most governments, and I would expect that to sort of gradually feed through over time. But yes, I mean, it has now been a very long and sustained dollar run, and that has made the life of every single African equity investor very difficult the last few years. It's been very difficult to find places to offset the inflation. I mean, the reason why the telcos have been such a good investment relative to other sectors is because it's one of the few sectors in Africa that has been able to grow consistently ahead of inflation. And that certainly has not been true in the other sort of consumer-facing industries.
So, Fred, are those the sectors of the economy that you'd be investing in now, or would you go for the resilient sectors? Would you be going for the telcos now because they haven't been hit as hard and they look pretty strong, or would you be going for the sectors that have been pounded and potentially rebound the most?
Yeah, let me answer this not directly. I think so. Certainly, like banks have just been clobbered. Some healthcare names that have done really well from a business standpoint, but their stocks are still significantly down. Like, I think there's opportunities in some of the most hard hit names, but also and certainly in the like kind of second and third tier, whether it's market cap, smaller mid market cap names, or second tier and third tier markets, like as Ghana came up earlier. And then as the kind of the sectors that have worked, like telecoms have worked, technology has worked. But if the way we think about technology's kind of runway is that you have this massive under penetration of internet penetration rates, but that they're growing double digits. And then you have all of these ecosystems that are going to grow from internet penetration adoption. And so like digital targeted advertising is almost non-existent on the continent. That presents tremendous verticals. Like advertisers want to go beyond just putting up radio ads and your kind of typical Coca-Cola ad on a mom and pop shop. And so you often find brands don't even know who exactly they're marketing to, other than just kind of the masses. And so if they're able to dial that in, you can get a much better ROI on your marketing spend. Digital payments, they make the world go round, and and cash is absolutely still king. I think we'd heard Egypt is still 97% cash transactions. And so meaning you can go from 3% to 100% at some point over the next, call it 30 years. And that is just a tremendous growth rate. Logistics, we talked about Andy spoke about the challenges of logistics. It's a product's cost is 75% generated from the cost of logistics on the continent, whereas in the US that's about 6%. And so there's tremendous margin to be captured there, as well as opportunity for the consumer to not have to pay as much and have more discretionary income to spend on other products, goods, services. And so for us, it's we're gonna stick with what we know, and we're tremendously excited about the next decade or so. So even like COVID brought forward, like, this is an ongoing theme, everyone talks about it in analyst calls, but it really is true that COVID brought forward digital adoption rates. So we like businesses that are kind of trying to transform themselves from the inside out, and really adopt the internet in ways to reach their consumer, to improve their user experience, to reduce friction. Excuse me, losing my voice here a little bit. So we're tremendously excited about the opportunity at hand. Yeah.
So quite forward-looking in terms of what the opportunity set is. Gerald, given the potentially more risk averseness of the pension fund market, what kind of sectors do they like in Africa? Highly cash generative, big balance sheet, low debt, I would assume.
Yeah, traditionally, when you're speaking to most of the investment managers that are mandated by the pension funds that we advise, those are the bellwether type of stocks that populate most of the portfolios. To be fair, if you're looking across many African portfolios, you are going to be hard pressed to preclude financial services. Generally, for both global investors as well as domestic investors, the ability to get access to a market with through stocks that offer you that high liquidity quotient, through stocks that are highly regulated, which most financial services firms are, through stocks that enable you to get access to the broader economy through one access point. We're speaking about digitization, and what Safaricom versus Equity Bank are doing, by way of example, is a massive draw card for both domestic investors as well as foreign investors. But similarly, so they, at least for domestic pension funds, there's also an acknowledgement that they do want to get exposure to a broader cross section of their economy, of which stock exchanges may not be representative of that broad cross section. So if it is, again, using Kenyan example, when you've got Safaricom, when you've got Equity Bank, and you've got two other banks, and that's 70% of your market, you're not actually exposed to the broader cross section of your economy: industrials, energy, healthcare, IT, and the like. So because of that, you're starting to see a transition in the portfolio allocations to accommodating either the investment vehicles or the asset classes that are giving them exposure to that broader cross section of the economy, and be that through private equity, be that through infrastructure, be that through specialist real estate funds and the like. You're starting to see an awareness to start broadening the asset allocation to actually the broader economy.
And Andy, how are you guys positioned at the moment in going forward?
So, can you hear me?
Yes.
Okay, so I'll try to answer and ask question at the same time so that it addresses the 2 points. So, starting with Anna's question about the fund performance during last year. So in US dollar, our performance was between -3% and -5%. And I think, Len, you mentioned market's performance last year was flat, if I'm not wrong, on average. So clearly we underperformed the average in Africa. But this was for two key reasons. The first one is because we have no exposure to Nigeria, which could appear a bit contrarian for an Africa dedicated fund not to have any money invested in Africa's biggest economy. And the reason behind this is just because we do not feel comfortable with the direction of the country in terms of monetary and fiscal management. I don't know if you follow that closely, but today Nigeria is a country where it is very, very difficult to get your money out of the country as a foreign investor because of the monetary policies that are in place. And the official exchange rate that you see on Bloomberg, for example, is not the exchange rate at which foreign investors are allowed to exit the market. So on the face of it, the performance of the Nigerian stock exchange, it was great last year. But in reality, it's not the case. And we prefer to stay out of Nigeria because those situations bring a lot of risk for investors like us. And we do not want to risk our investors' money in this type of situations, which is a bit like what we saw in Zimbabwe a few years ago, and still now it's very, very difficult as a foreign investor to take your money out of the country. So this is one explanation for the small underperformance. And another one is related to commodities. I would say as an Africa fund, we obviously invest in commodity names, oil producers or gold miners, but we tend to remain underweight because we don't think that this is the best way to approach growth in Africa, because commodities are, I would say, cyclical sectors that rely a lot on global trend, and the way we invest in Africa is to really target the structural reforms that are done in Africa to provide long-term appreciation of capital. And commodities do not really fit, I would say, that space. So obviously, we benefited a bit from the rally in the gold names, but not as much as our benchmark or most of the stock exchanges that have a lot of commodities inside. So now talking about the positioning, I will say that the countries that we like and where we have most of our money invested are Egypt and Morocco, because these two countries, in our view, are well positioned to recover from the difficult times brought by the COVID-19 crisis. From a structural point of view, obviously a macroeconomic point of view, and then we are also invested in South Africa because the South African market is well connected to the global liquidity. And when we talk about portfolio flows coming back into EM markets, South Africa is definitely well positioned to benefit from this global liquidity coming back. But I will say our positioning in South Africa is more a tactical one, short term, but not a real fundamental approach, which is more 3 to 5 years. So we position also ourselves on a tactical point of view in South Africa. And the last one is Kenya, where we do think that you will have a strong rebound in GDP growth post the crisis. They are putting in place some measures to help them to drive this strong economic recovery. I'm not sure if you saw it, but I think it was last Tuesday they reached a staff level agreement with the IMF to access $2.5 billion. So this kind of options to access external funding will help them to drive a strong economic recovery in the next few years, and this is something that we do like. Obviously, in Kenya, you don't have that many companies in which to invest, but I would say the main ones were invested in those names. We still keep an eye on Nigeria because Nigeria can come back pretty strongly as well from a pure macro point of view, but at this stage we prefer to stay away. We monitor the situation, but we are still not invested in Nigeria.
Thank you. In your defense though, I was quoting our indices, and it is very difficult to construct relevant indices in Africa because of the problems that you were talking about. And I know that what Francis was saying earlier, Nigeria's had some issues with their currency this year. I think they've devalued it twice this year. And we've got a joint venture with FMDQ, which is the big bond market up there, and it's been a bit of a problem for some of our clients. We've got 5 minutes left, gents, and we've kind of had a look at what the short-term scenario is and how we think Africa is going to go for the next year or so. But as Fred alluded to earlier, this is a much longer-term play. What does Africa need to continue doing, and what does it need to stop doing to realize the potential that investors like Fred's fund have seen in it? Is it as simple as education, healthcare, or are there bigger issues at play in terms of fiscal and monetary policy and making Africa an easier place to do business? Fred, do you have some views on that?
I think certainly long-term, continue to invest in education. That'll pay dividends down the road. Similarly, I would say stop investing in oil and gas and instead harbor natural resources like the sun, which is not going anywhere, hopefully. Nearer term, just like continue, I would tell policymakers and regulators to continue to work and try and like think of yourself as government as a platform, and like your job is to harbor and create as a robust economy as possible, and then you're a toll roll taking tax along the way, and so like try to grow the private sector, do everything you can, so work with business owners, work less with lobbyists, and listen to and adopt all things internet related would be my recommendation.
I suppose that brings up an interesting point as well, is that Africa to a large extent is playing catch up, and in the years that China was industrializing and building factories and things, there wasn't this focus on ESG that we currently have. Francis, how does Africa industrialize within the limitations that ESG type of investing places on it? It's quite a difficult thing to do, and potentially the answer is to go more of a technology route rather than a manufacturing kind of route.
Yeah, I think you've hit on a theme which is always in the back of my mind, which is, clearly, I guess China developed at a period in human history where kind of robotics were clearly not anything like as advanced as they are today. We have a very young, large population that that needs to have the basic human dignity of having a job, and it is fair to say in a lot of countries in Africa, youth unemployment still leaves a little bit to be desired. And so, yeah, I mean, for the points that kind of Fred made earlier, all of those things and an enabling environment are what are going to kind of lead to job creation. I think it goes about saying that the ethical standards need to be in place in order for investors to be comfortable with putting capital to work in Africa. I think the other thing I would say, just on the topic of ESG investing and in particular looking at it through an impact lens, I mean, this is a major trend for very important reasons, right? The world has really got to kind of start steering capital towards the right type of projects, which are going to lead to kind of a healthy and sustainable planet, of course. But in the African context, actually, kind of arguably nowhere in the world is there more of a kind of impact investing opportunity. So, if you're launching an impact fund today, it's actually relatively easy to find clear-cut impact cases. I mean, just looking at the telco again, they're providing, unlike in other parts of the world, telcos are effectively providing financial inclusion to people. So I do think, Africa's industrialization is critical. There are question marks in and around kind of how that works in terms of kind of creating enough jobs for people in this day and age. But the ESG lens is only going to grow in importance every single year. And speaking as a former kind of buy-side investor, I mean, the amount of questions and scrutiny that you would get from your clients these days with regards to your ESG integration and what you're doing is just huge, and it's going to grow and grow and grow.
Fantastic, gentlemen. Does someone want to just answer that last question that we have on the chat? I presume, Andy, you might be the best place to do that.
Well, as I'm a French speaker, maybe, but as an investor, unfortunately, no, we are not investing on the BRVM. Unfortunately, first of all, because our relationships with the custodian is quite strict, and for now, they are not that comfortable with the level of disclosures, I would say, and the risk in those markets. But obviously, this is a permanent discussion that we have with them, and hopefully, this opportunity will be open to us. However, it doesn't mean that we do not monitor. Obviously, we follow the main names listed on the BRVM, Sonatel, and the others. But yes, unfortunately, we do not have any holdings invested there at the moment.
I can't disclose the name, but we do have an investment there.
Okay, fantastic. Well, gentlemen, that's our time is up. So I was going to have a section on the risks of investing in Africa, but I suppose we can leave those for now. But I think just to conclude, it sounds like Africa is really a good investment destination, particularly over the next, or for the next 10 to 15 years, not a short-term destination, but that there are some risks that are kind of going away, and there are others that still need to be addressed. Is that a reasonable synopsis of investing in Africa, Gerald?
Yes, definitely.
The only thing I would add is just valuations are just, in many of these companies, are just outrageously cheap on a relative scale and absolute scale. And at the end of the day, valuations matter when you're making investments. So, yeah.
Fantastic. Well, gentlemen, thanks very much. I think it's been very, very interesting, particularly for me, who's a non-investment professional from an active management perspective. And I've really enjoyed our chat. So thanks very much.
Thank you very much, Len.
Thanks so much.
Thank you.
Thank you, everybody.
Bye-bye.